What if I told you that there's a simple strategy in the stock market that can slowly turn a small investment into a growing stream of passive income, and almost nobody talks about it? Most people believe that making money in the market requires constant trading, risky bets, or finding the next big tech stock before everyone else. Social media is full of traders promising fast profits and overnight success. But here's the surprising truth. Some of the most successful long-term investors aren't chasing hype at all. Instead, they quietly use a simple strategy that allows their money to grow automatically year after year. In fact, with the right approach, even something as small as a $1,000 investment can start turning into a passive income machine over time. And the strange part is that banks and traditional financial institutions rarely highlight this method. Why? Because this strategy encourages people to build wealth independently instead of keeping their money sitting in low-interest savings accounts or expensive financial products. The strategy I'm talking about revolves around something incredibly simple. Dividends. Certain companies actually pay you money just for owning their stock. That's right, instead of waiting for the stock price to rise, these companies share part of their profits with investors on a regular basis. But the real secret isn't just collecting those dividend payments. The real magic happens when those payments are reinvested automatically to buy more shares, which then generate even more dividends. This creates a powerful compounding cycle where your money starts producing more money, and that money begins producing even more money. Now here's where things get really interesting. Most beginners completely miss this opportunity because they treat dividends like free spending cash. When they receive a dividend payment, they withdraw it or let it sit in their account doing nothing. But experienced investors often do the exact opposite. Instead of spending those dividends, they reinvest them using something called a Dividend Reinvestment Plan, also known as DRIP. This simple feature automatically uses every dividend payment to buy more shares of the same investment. Over time, those extra shares begin generating their own dividends, which buy even more shares, and the process repeats again and again. At first, the growth may seem small, almost invisible, but as the years go by, the effect of compounding can turn that small beginning into something surprisingly powerful. It's very similar to a snowball rolling down a hill. At the start, the snowball is tiny and barely noticeable, but as it keeps rolling, it collects more snow and becomes larger and larger until it turns into something massive. That's exactly how dividend reinvestment works inside an investment portfolio. In this video, I'm going to break down exactly how this strategy works, step by step, so anyone can understand it. Even if you're completely new to investing, we'll start by explaining how dividend stocks actually pay investors and why many of the world's largest companies distribute profits to shareholders. Then we'll look at the biggest mistake most investors make with dividends and why it prevents their money from growing faster. After that, I'll show you how the DRIP strategy creates a compounding snowball effect that can turn even a small investment into a steadily growing portfolio. We'll also walk through a realistic example of how a $1,000 investment can grow over time when dividends are reinvested consistently. And finally, I'll show you how beginners can start using this strategy step by step using a regular brokerage account. By the end of this video, you'll understand why many long-term investors rely on dividend reinvestment to quietly build passive income streams that grow year after year. And the best part is, this strategy doesn't require huge amounts of money or complicated trading skills. All it really requires is a smart approach, a little patience, and enough time for compounding to do what it does best. So, if you want to learn how a small investment can slowly transform into a growing passive income stream, keep watching because the strategy you're about to see might completely change the way you think about investing. What are dividend stocks? Before we talk about the strategy itself, we first need to understand what dividend stocks actually are. When you buy a stock, you are essentially buying a small piece of ownership in a company. If the company grows and becomes more profitable, the value of that ownership can increase over time. But some companies go a step further and reward their shareholders directly by sharing a portion of their profits. This payment is called a dividend. A dividend is simply money that a company distributes to its investors, usually every quarter. Think of it as the company saying thank you for owning its stock. Instead of keeping all the profits, the company shares some of it with the people who invested in it. Many large, stable companies have a long history of paying dividends. These are often businesses that generate consistent cash flow and don't need to reinvest every dollar back into growth. For example, companies in industries like consumer goods, healthcare, energy, and utilities often pay dividends because their businesses are mature and profitable. Investors who focus on these types of companies are known as dividend investors. Their goal is not just to benefit from rising stock prices, but also to collect regular income from dividends. Now this creates an interesting opportunity. Imagine owning a group of companies that literally pay you money just for holding their stock. Over time, those payments can add up and eventually become a meaningful source of passive income. Some investors even build entire portfolios designed to generate steady dividend income every year. But here's something important to understand. There are two main types of investors in the market. Growth investors focus on companies that reinvest their profits to grow rapidly, while dividend investors focus on companies that return profits to shareholders. Both strategies can work, but dividend investing offers something unique: a regular cash flow that can grow over time. And this is exactly where the DRIP strategy begins to unlock its true power. The problem most investors make. Now that you understand what dividends are, let's talk about the mistake most investors make when they receive them. When people first start investing in dividend stocks, they often see dividends as extra spending money. When a dividend payment arrives in their brokerage account, they might withdraw it, spend it, or simply leave it sitting there as idle cash. At first glance, this doesn't seem like a big problem. After all, receiving money from your investments feels like a reward. But this habit actually slows down one of the most powerful wealth-building forces in finance: compounding. Compounding works best when money stays invested and continues to generate additional returns. When you remove dividends, instead of reinvesting them, you interrupt that compounding cycle. It's like planting a tree and cutting off its branches every time it starts growing. Let's say you invest in a stock that pays a 4% dividend. If you invest $1,000, you would earn around $40 in dividends during the first year. Many investors would simply take that $40 as cash. But by doing that, the investment remains stuck at $1,000 and doesn't grow much faster. Over time, this difference becomes massive. Investors who consistently spend their dividends miss out on the snowball effect that makes dividend investing so powerful. Instead of their portfolio growing faster and faster, it grows slowly and sometimes barely keeps up with inflation. This is why many experienced investors follow a different approach. Instead of spending dividends, they reinvest them back into the same investments. This allows the portfolio to buy more shares, which produce even more dividends in the future. And this simple shift in thinking leads us to the strategy that many long-term investors quietly use to build wealth: the DRIP strategy. The DRIP strategy, explained as the DRIP strategy, stands for Dividend Reinvestment Plan, and it is one of the simplest ways to harness the power of compounding in the stock market. Instead of receiving dividends as cash, a DRIP automatically uses those dividends to purchase additional shares of the same stock. This process happens automatically through most brokerage accounts. Once you turn on the DRIP option, every time a dividend is paid, that money is immediately reinvested to buy more shares. Even if the dividend amount is small, the system will purchase fractional shares so that every dollar continues working for you. Let's look at a simple example. Imagine you invest $1,000 in a dividend stock that pays a 4% annual dividend. After the first year, you receive $40 in dividends. Instead of withdrawing that money, the DRIP uses it to buy more shares of the stock. Now you own slightly more shares than you did before. In the next year, those additional shares also produce dividends. This means your dividend payment becomes slightly larger than the previous year. Year after year, this process repeats itself. Your dividends buy more shares, those shares generate more dividends, and those dividends buy even more shares. Over time, the growth starts to accelerate. This is why many investors refer to dividend reinvestment as a snowball effect. At first, the progress feels slow because the numbers are small. But as more shares accumulate, the dividend payments become larger and the growth begins to speed up. Eventually, the portfolio reaches a point where the dividends themselves are large enough to create significant passive income. And the incredible part is that this entire process can run automatically once the DRIP strategy is turned on. Compounding example. To truly understand how powerful this strategy can be, let's walk through a realistic compounding example. Imagine you start with a $1,000 investment in a diversified dividend portfolio. Let's assume that over time the portfolio generates an average return of about 8% per year when dividends are reinvested. At first, the growth may not seem very impressive. After the first year, the investment grows to around $1,080. In the second year, the growth is slightly larger because the returns are now being calculated on a bigger amount. After 10 years, that original $1,000 investment could grow to roughly $2,100 at this stage. Many people might feel disappointed because the progress seems slow compared to the hype surrounding fast trading or speculative investments. But this is where patience becomes incredibly important. Compounding accelerates over longer periods of time. After duopoly years, that same investment could grow to around $4,600. The growth is starting to speed up because each year the returns are being generated on a larger base. After 30 years, the investment could reach more than $10,000. And remember, this example assumes no additional money was added after the initial investment. The key lesson here is that compounding rewards time. The longer the money stays invested and reinvested, the faster it can grow. This is why many successful investors focus less on short-term market movements and more on long-term compounding. When dividends are consistently reinvested through the DRIP strategy, every payment becomes another opportunity for the portfolio to grow. Now let's take it a step further. Instead of investing only once, you also add $100 per month to your portfolio. This small monthly contribution might not seem like much, but over time it significantly accelerates the compounding process. After 10 years of investing and reinvesting dividends, your portfolio could grow to around $18,000 depending on market returns. At this point, the dividends generated by the portfolio are already becoming noticeable. After 20 years, the portfolio could grow to somewhere between $40,000 and $70,000 depending on market performance and dividend yields. If the average dividend yield is around 4%, that portfolio could generate between $1,600 and $2,800 per year in passive income. And the powerful part is that the dividends can continue growing as companies increase their payouts over time. This is how many long-term investors slowly build dividend income streams that eventually cover expenses like bills, travel, or even retirement income. It doesn't happen overnight, but with patience and consistency, the process can be surprisingly powerful. How to start the DRIP strategy? Starting the DRIP strategy is actually much easier than most people think. In fact, many modern brokerage platforms allow investors to activate dividend reinvestment with just a few clicks. The first step is opening a brokerage account if you don't already have one. Most online brokers allow you to buy stocks and ETFs with very low fees and minimal starting capital. Once your account is set up, the next step is selecting dividend-paying investments. Many investors choose individual dividend stocks from stable companies with long histories of paying and increasing their dividends. Others prefer dividend-focused ETFs that hold dozens or even hundreds of dividend-paying companies. After purchasing the investment, you simply enable the DRIP option inside your brokerage account. Once this feature is activated, all future dividends will automatically be reinvested into the same investment. This means every dividend payment immediately buys additional shares without requiring any manual action. Over time, those extra shares produce even more dividends, which continue fueling the compounding cycle. It's also important to stay consistent. Many investors combine DRIP with regular contributions, such as monthly investments, to accelerate growth even further. The beauty of this strategy is its simplicity. You don't need to constantly trade stocks or predict short-term market movements. Instead, you focus on owning quality dividend investments and allowing time and compounding to do the heavy lifting. And while the process may start slowly, the long-term results can be incredibly rewarding for investors who stay patient and committed. So here's the real takeaway from this entire strategy. Building wealth in the stock market isn't always about finding the next hot stock or making risky trades every week. In many cases, it's about using simple strategies that quietly work in the background for years. The DRIP strategy is one of those methods. It may not look exciting at first because the growth starts slowly, but over time, something incredible begins to happen. Your dividends buy more shares, those shares produce more dividends, and the cycle continues again and again. Eventually, your investments start generating their own income stream without you having to constantly add new money. Think about it this way. Most people spend their lives working for money. But strategies like dividend reinvestment allow your money to start working for you. And the earlier you start, the more powerful the results can be because compounding needs time to grow. A $1,000 investment today might not seem like much, but with reinvested dividends and patience, it can slowly grow into a portfolio that produces real passive income. The biggest mistake people make is waiting. They think they need $10,000 or $50,000 to start investing. But that's simply not true. Many successful investors started small and let consistency do the heavy lifting. The goal isn't to get rich overnight. The goal is to build an income-producing portfolio that grows year after year. So, if this video helped you understand how the DRIP strategy works, let me know in the comments by typing DRIP below. And if you want more videos about dividend investing, passive income strategies, and smart ways to grow your wealth, make sure you subscribe to the channel. Because on this channel, the goal is simple: helping you make your money work for you instead of the other way around.